We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Jeff Snider, Head of Global Research at Alhambra Investments. Thanks for joining me today, Jeff.
Hey, Tom. Thanks for having me back.
It's excellent to speak with you again. I was really looking forward to it because you're such a wealth of knowledge on the EuroDollar system, and I think it's worth trying to dig into some of that. So why don't we start by talking a little bit about a recent article you wrote entitled "The Real Money Doesn't Spread Inflation," and in it you go through the importance of swap spreads and how that system has never really recovered since the 2008 Great Financial Crisis. So what are swap spreads and why do they matter to us?
Well, swap spreads are a quirky, not little part of the fixed income monetary financial system. They're actually a really big part of it, but they're not really well known because, unless you're trading deep into the guts of the internal fixed income system throughout the world, you really don't have any interest in interest rate swaps or what they tell us. And an interest rate swap spread is, as the name implies, related to the interest rate swap quoted price, which an interest rate swap is a swap for fixed for floating interest rates. And it's usually quoted by the fixed leg part of that swap. And we take that fixed leg quote and compare it to something like the U.S. Treasury yield, because the U.S. Treasury yield is considered the risk-free or nearly risk-free, to give us some idea of what the market is thinking as far as systemic credit risk, systemic liquidity risks, and things like that. By and large, we would expect, at least before 2008, that the fixed leg quote of this interest rate swap would be above the risk-free treasury rate, because why? Of course it would. It represents some risk. If you're engaging in an interest rate swap with some financial counterparty, that financial counterparty has given you some form of risk. You have some form of risk in that contract. So the quoted leg of the fixed leg of the swap should be quoted above the U.S. Treasury. But in October of 2008, at least the long run, the swap spread, the 30-year swap spread, all of that changed. And all of a sudden we had negative swap spreads. And this is October 2008, remember? So what that told us was something very deep, something very significant changed very deep inside the global monetary system, such that here we have this massive market that's fundamental to the fixed income system throughout the entire world in US dollar terms, had kind of turned upside down, and it turned upside down in a way nobody thought was actually possible. How could we have a negative swap spread? Because if you stop and you think about it in the way we're supposed to consider swap spreads, did that mean that the market was thinking over a 30-year period, the U.S. government was more risky than the bank counterparty you were engaging in the swap with? Mm-hmm. And a lot of people struggled with this, with trying to answer this question, because it didn't seem to make a whole lot of sense. But that was really the point. It was nonsense. It wasn't the market saying that suddenly financial counterparties were less risky than the U.S. government and U.S. treasuries. What they were saying was there was such a massive imbalance in the monetary system. It was producing all sorts of chaotic results, including the swap market going haywire, and that dealers were absent to arbitrage away what should have been free money spreads, getting spreads back up to above treasuries. The fact that didn't happen, and that swap spreads at the 30-year went negative, they went closer to zero at the 10-year, and they fell dramatically lower at short terms too. The fact that dealers were not in the marketplace arbitraging those spreads back to where they quote unquote should have been was a key warning sign that the global financial crisis was actually a very deep financial crisis. And if you remember October, November 2008, the Fed had already done all of its emergency programs. The level of bank reserves have skyrocketed, supposedly a flood of money. Yet here we're swap spread telling you that no, this was not an effective response by the Fed. We were still gripped by the worst monetary panic, first global monetary panic in 4 generations since the 1930s. So swap spread tell us something very meaningful about what's going on in this hidden money world, this Eurodollar world, especially as it relates to some of the more fundamental mechanics that not just money, but fixed income credit economy and all the broader implications to it.
Mm-hmm. So Jeff, when we think about what you were saying there about that dealers weren't there to kind of fix that system, why did they in a way get kicked out, and who replaced them?
Well, it's not that they didn't kick out. They exited. They moved. What happened was, if we want to revisit the 2008 crisis, which I think needs to be done because everybody still thinks it was about subprime mortgages. It really wasn't. It was about dealers, because money dealers, these banks, these global banks, are the money. They are the Eurodollar system, and without them, there is no money. There is no finance. There is no order in these marketplaces. Liquidity dries up because it's a dealer bank driven system. Mm-hmm. So if dealers are banks and banks are money and money is inflation, without the dealers, you don't have the money, you don't have the inflation. In 2008, that was, we had the most stark example of that because we had outright monetary contraction and deflation, which we noted as the global financial crisis. Mm-hmm. So it wasn't that, the dealers weren't, the system had imploded to the point where dealers were just deciding they couldn't do all of the things that they had done before the crisis because they had to reevaluate everything they were doing. And it led to the self-reinforcing feedback loop where the worse it got, the more dealers exited. The more the dealers exited, the worse it got liquidity-wise, and therefore we're kind of stuck in this trap. Meanwhile, the Federal Reserve was trying desperately to break the cycle, so to speak, but we found out that they were not equipped to do so because bank reserves are not actually a substitute for this dealer-driven shadow money system. And so the Fed was ineffective in its responses because they couldn't replicate all the things that money dealers do inside the system, including trading in an interest rate swap market, trading in credit default swaps, for example, repo collateral, all these kind of shadow money fundamentals that dealers do that the Federal Reserve doesn't do. So without the dealers, there isn't the money for the system to work. And without the system working, things tend to get chaotic. Things tend to get really bad in the real economy.
Mm-hmm. So when these swap spread curves start to compress, what is that a sign of, Jeff?
That's a sign of exactly what I'm saying. That's a sign that dealers are pulling back balance sheet capacity that they're offering that would otherwise police this marketplace, create the arbitrage, the hierarchical structure where we expect swap spread prices to the fixed leg part of the swap spread quotes to be above U.S. Treasury yields. In fact, as you're alluding to, Tom, the 30-year swap spread hasn't been positive except for a brief moment in 2013 ever since October 2008. This isn't just a short-term issue. This has been a consistent issue that goes along with the fact that the 2008 crisis, not only was it not subprime mortgages, it was a total dollar breakdown. It was not a one-off event. So we look at swap spreads, we look at their history of them since 2008, and they tell us a couple important things. Number one, it wasn't subprime mortgages. It was the money-based, dealer-based system. And number two, it was not a temporary event. It wasn't just a one-off crisis. It was a systemic change in character. It was basically a rupture in the global monetary system, and it hasn't changed since then. So we have this overriding, 13, 14 year now of broken system, but it kind of goes back and forth over that interim period where it appears like it gets a little bit better, where the dollar shortage or the monetary shortage, the dealer constraints aren't so bad. And we see that in the swaps market where the spreads will decompress a little bit, not a lot, but a little bit. And decompress means they go back to where they should be. They at least go back in the right direction. And then we go into these cycles where all of a sudden swap spreads start to compress again, which is, dealers removing balance sheet capacity, taking on more constraints for whatever reasons, and therefore limiting the amount of dealer capacity, therefore monetary resources for the global monetary financial system. So we've kind of had this back and forth inside this overriding structural change, going all the way back to August of 2007.
Mm-hmm. So as we think about, the fact that this system has been broken since then, how has it been able to function? Is it simply a function of the Fed just, supplying that liquidity and, acting as a backstop in some ways, Jeff?
No, that's the thing. The reason it's broken is because the Fed doesn't supply liquidity. That was one of the supports that during the pre-crisis era, one of the assumptions really was that the Fed would always stand behind the system. And so dealers and banks all over the world took enormous risks because they thought if push came to shove, this Greenspan put idea, the Fed would stand behind everything if it ever really got bad enough. And what happened was in 2007, around the time that Bernanke said subprime was contained, dealers started to realize the Fed wasn't an effective backstop at all. They could not come into these markets and support them. They could not create balance sheet capacity in dealers. They could not create collateral, for example, as mortgage bonds were being revalued and the haircuts adjusted. Mm-hmm. So that was part of the reason why the 2008 crisis became a systemic rupture, was this breakdown in the theory and then the assumption that, oh my God, the Fed isn't going to stand behind. We really are by ourselves here. We are all alone. We could become the next Bear Stearns, which is why you see Bear Stearns, when that event happened in March 2008, that's prominent on all sorts of market charts, because that was the moment when the dealers realized the Fed really isn't going to stand behind. They can't. They don't provide liquidity. So how, to answer your question, how has it, how did we survive 2008? Why didn't it become something like the 1930s? Well, there's some minimal level of function there. And putting it in terms of Milton Friedman's idea of tight money, it's not that the system just completely contracted and stayed forever in that state. It's that it doesn't provide enough resources for us to get out of this post-crisis rut in terms of markets as well as economy. So it does function to some degree, but never enough to create an actual recovery. We're kind of stuck in a lower energy, lower oxygen level state where the real economy, the marketplace really can't get going. But yet it's not the same as it just shuts down and turns everything off either. It, as I say, it keeps the lights on. It's enough to keep the lights on, but never do anything more than that, which in many ways is the worst case. Mm-hmm. Because, if it just shut down, then we would know that there's a problem that needs fixing. But the fact that it continues to go forward, even with a sort of a minimal level of function, nobody kind of knows what's wrong here. And they're not really looking in the right places for answers. So in a lot of respects, it is the worst case.
Mm-hmm. So Jeff, if you were, had a genie, what do you think would be a good solution to that if we were to be able to fix that system?
Well, there's really two kind of answers, right? One would be, the obvious answer would be, how do we fix what we have and go back to the way it was before, right? Because if we had a rupture around 2007, in August of 2007, can we just wind the clock back to July 2007 and start over? Mm-hmm. The answer, I think, is a resounding no, because if we could, that would have happened before now.
Right.
And really, we should stop and think of whether that's actually a good idea or not, because when you really look at the pre-crisis era, do we really want to go back to subprime mortgages and all the crap that happened during that age? And I think the answer is no. I don't think it was a very good idea to begin with. Mm-hmm. And I think people get the wrong impression about me because I study the Eurodollar system. They think I'm a proponent of it. And that could not be farther from the truth. It was not a very good monetary system. It was not a very good arrangement. I mean, in the beginning, it sort of solved the problem that we had, Triffin's paradox, back in the 50s and 60s. But it got way out of control. Let's be honest. I mean, the pendulum swung way too far in the other direction, and it created basically this worldwide credit bubble in the late 90s and in the middle 2000s that just exploded in this global financial crisis. I don't even know if we want to go back to that, because it was inherently unstable and inherently flawed to begin with. So if we can't go back, how do we go forward without the Eurodollar system? And that's really, I think, the question some people are starting to wrestle with as it pertains to things like digital currencies and things like other solutions like that can potentially offer a compelling option that isn't the way we're doing things now. Maybe there's another competing currency system out there that doesn't have all the excesses of the Eurodollar system, but maybe preserve some of the good parts about it. Because there were some good elements to the monetary system. It's just that it was unrestrained. It was particularly unrestrained by the end of it. So it's about not going backward, but moving forward, taking the best parts of what we have and maybe applying some historical lessons to what we've learned. And, what I think people who study the gold market know intuitively throughout history, that some monetary restraint is a good idea.
Yeah, that's a very, very important idea. And, having a little bit of monetary restraint seems to be a rare perspective nowadays, right?
Oh yeah, it's rare. It's exceedingly rare, and that's there's a narrow, maybe not even so narrow, but there's what we're trying to do with a monetary system is match the dynamic demand for money with a somewhat dynamic supply of it, and it's really a messy thing. It's any number of ways to try to do that, and the Eurodollar system way of doing it eventually was, hey, we'll just do money. Unrestrained money creation. We'll just throw money at everything, which as most people interested in gold and historical gold standards and hard money systems know, that was destined to be a problem from the very beginning. So there has to be a way to preserve some of the good elements of the Eurodollar system with some of these historically hard-won, hard money lessons that say some form of constraint is a good idea. But we don't want to go too far in that direction, though. We don't want to have a completely rigid system where there is no dynamic supply of money, because we do need a dynamic supply of money. We live in a dynamic world where things are constantly changing. As I keep alluding to here, the Eurodollar system was really good at adapting to circumstances. It was very flexible and very fluid. As Robert Solomon said, it had an adjustment function that was very suited to this modern, innovative, technologically changing landscape that probably no other form of money could possibly, at least not invented yet, could have possibly had supported. So the level of globalization from World War II on to the end of the 20th century, a lot of that was made possible by this dynamic supply of money. So that part was good, but we just needed some form of restraint on the other side. So how do we get the best of both worlds, where we have some dynamic supply, but never too much? And of course, we're basically sketching out the most ideal, maybe unrealistic kind of framework where, it gets very messy the further into the details you get. But generally speaking, I think that's what we need to do. We need to adapt the Eurodollar system into a more realistic framework where it's not just completely willy-nilly unrestrained, everybody just do whatever the hell they want. Some form of discipline.
Jeff, when we think about, foreign officials selling treasuries, this isn't necessarily because they're trying to hurt the US dollar or get rid of dollars, correct? It's because they have a dollar shortage. So does this, constantly create demand for dollars outside the US?
It's not it's in response to the constant demand for dollars, because the US dollar denomination, the Eurodollar system is the reserve currency. Everybody always needs dollars. Otherwise, you can't participate in the marketplace. And by the marketplace, I don't just mean merchandise trade flows. I also mean financial flows. Without the US dollar intermediating between these various different systems, you're kind of cut off. So you always need dollars. And ironically, Tom, foreigners selling US treasuries, especially foreign officials selling US treasuries, correlates almost exactly with what we talked about at the beginning, swap spreads. When swap spreads are compressing, bad sign, tight money sign, we tend to find foreign officials selling treasury during those periods, which actually makes a lot of sense when you get out of the geopolitics of, everybody hates the dollar, everybody thinks the Fed's printing money, all that stuff that you hear in the news, on the internet, wherever. That's not what happens. What happens is foreign central banks and foreign finance ministries have tended to sell their treasuries, in particular China, when they have a dollar problem, because they're mobilizing these reserves to try to create dollar liquidity that local banks in their jurisdictions aren't able to easily get from the Eurodollar system. So it's a bypass mechanism. It's a workaround mechanism. When the Eurodollar system breaks down, dollars become tight globally. That's when we see, among other things, swap spreads tighten, as well as foreigners selling their treasuries. They're responding to the same things, which is a global dollar shortage of some intensity.
Jeff, has the Eurodollar system really changed the inflationary landscape that we see in the US dollar? It seems like in the 50s, you wrote another article that there is like almost two different regimes of inflation. So is it almost pre-Eurodollar and post-Eurodollar? And what were the effects of the Eurodollar on inflation?
Yeah, it's funny. I'm not the only one who's noticed either. The Bureau of Labor Statistics, which is they're the folks who keep the U.S. CPI and calculate the CPI, they said, hey, a weird thing happened around middle 1950s. Something changed in inflation. It was kind of weird. They didn't explain it, but they noted it and said, before the middle 1950s, we saw, the Great Depression, obviously, deflation. And then coming out into World War II and coming out of World War II, we had these supply shocks where the CPI would just jet higher. In 1947, 48, for example, the CPI almost got up to 20%. And everybody said, oh, this is inflation. But then it would only be temporary. It would come right back down. And then there was another one in 1950 and 1951. So the CPI got up to around 15%, and then it came right back down. So you had this period where consumer prices would accelerate in bunches, but it wasn't sustained inflation. And then you get on the other side of 1955, and all of a sudden you started to get the slow rise in inflation that was more sustained, not short, sharp periods, but more of a sustained rise. At first, it was nothing much, but then you get into the middle 1960s, and obviously it became the Great Inflation, where it was relentless. There was no getting out of it. And so the question then is that the BLS never answered, but what happened in the middle 1950s that would cause inflation to change its very character, consumer prices to change in the way they acted? And the answer is, to me, obviously, the eurodollar, because the eurodollar showed up somewhere around 1955. Not just random coincidence there. This grand monetary experiment began around the middle 1950s, and it really took off around the same time as the Great Inflation did in the 1960s. Mm-hmm. So we have this monetary evolution where banks operating outside of the United States, denominating their assets and liabilities in US dollars, but were in a lot of ways unrestrained in how they could do it. And they weren't exactly unrestrained. There was rules governing how banks interacted with each other and what they could do. But by and large, it was an unfettered money creation period lasting from the middle 1950s to around August of 2007. So we had inflation, a monetary system centered on the eurodollar, therefore inflation, not just in the US, but around the world, based on that eurodollar system and how it spread at globalization, how it spread, productive capacity and growth throughout the rest of the world. And then on the other side of August 2007, consumer prices, particularly in the US, they've started to look like they did before 1955. We see these short, sharp bursts of consumer prices that isn't the same as inflation because the eurodollar system is no longer functioning the way it had. So it's almost like the perfect bookend. We have the 1955 shift, and then we have the 2007 change, where in between massive monetary creation, growth, all that stuff, outside of those, consumer prices behave very differently. And I think the article that you're alluding to, I said that, how do we tell which one is which in real time? We look at bond yields, we look at the Treasury market, because the Treasury market and long-term bond yields are growth and inflation expectations. So that we would expect long-term Treasury yields to pick up on this regime change in inflation, both sides. And in fact, when you look back through history and look back through recent history, that's exactly what you do find. Bond yields in the 1940s and the early 1950s, they ignored those sharp spikes, those supply shocks in consumer prices because they were temporary. They weren't inflation. Dare I say transitory. They weren't the same thing. But then you get fast forward into the late 1950s and especially the 1960s, then you see bond yields begin to rise in anticipation of the sustained monetary inflation that followed. Fast forward to the 21st century, and the same thing. Before 2007, we had bond yields that were above CPIs. In fact, they matched pretty closely the ebbs and flows in consumer prices with the ebbs and flows in Treasury yields. Then you get to August 2007. Again, the consumer prices change the way they behave. We get the sharp spikes, one right in 2008, which we all know today was not inflation. It was a sharp spike in oil prices during a deflationary event, which the Treasury market told you in real time was a deflationary event because bond yields were falling during it. And bond yields since 2008 have only gone lower and lower and lower, ignoring the CPI spike in 2011, saying that wasn't inflation either. And relevant to our current discussion, they've ignored the even larger spike in consumer prices, which showed up last year, bond yields telling us in no unequivocal terms, this is not inflation either. This is another supply shock transitory period.
Mm-hmm. Yeah, as you're explaining that, Jeff, it makes me think that the cure for high prices is high prices. That mechanism of
yes.
of solving high prices by a reduction in demand because normal people can't afford those goods anymore, and then the prices coming back down to meet that new level of demand. Yeah, it seems like in that middle term that was almost broken in a way, right?
Yeah, when there's money flowing, then you have it going through credit, you have it going through wages, you have it going through a lot of things where prices can go up and stay up. That's really what inflation is. When you have this rush of money, it's almost like oxygen feeding a firestorm, right? We blow a bunch of oxygen into a firestorm, it can sustain itself for a very long and destructive period of time. But without that oxygen, it destroys too much, and the fire just goes out, right? Mm-hmm. It gets to its limitations and it can't go any further. And I love how you put that. It's exactly right. Price, the limit of prices is the limit of prices, right? Because especially oil prices. When oil prices go up through the roof, that causes a widespread level of harm throughout the economy that ripples in every single direction. And it's, we can't, we don't know what the threshold is where it triggers that reset function. But at some point, oil prices, gasoline prices, they just, if regular folks are paying too much at the pump, they have to restrict discretionary spending and other things, which restricts economic growth in other sectors. So really, we're redistributing, in a very wasteful manner, we're redistributing economic activity toward the oil sector that doesn't really help the economy stay up. And if there isn't that monetary component to it, then that's really all that we're doing. We're just redistributing, rejiggering. We're not growing the nominal economic pie at all. And so eventually there's a limit to that, and it has to kind of come back on itself. It has to be restricted. It ends up being transitory because it's nothing more than a supply shock. So without the money, it's not really inflation, it's something else. And almost by definition, it has to be temporary.
Yeah, it seems like when these periods come into existence like that, naturally we kind of think that there should be, like you say, a transitory end to it, considering that the economy can only take so much if wages and that wage price spiral can't continue upwards, considering that if you have a higher wage, you can afford more, at the pump or at the grocery store, right?
That's the economic theory, right? And that's the theory which the Federal Reserve right now, and not just Fed, but the Bank of Canada and everybody else is operating under, is that since the 2020 recession, the economy in the United States and other places around the world has recovered enough that we're in that kind of danger zone where the U.S. labor market has reached maybe its maximum employment level, which they don't use that terminology anymore because it burned them so badly last time. You'd think they'd learn, but anyway. The unemployment rate's down to around 4% again in the U.S., which the Fed is now concerned maybe that does trigger the wage price spiral. So even though the Fed believes that in the supply shock, transitory inflation of last year, they're concerned that because consumer prices are still high and moving higher, even if they are transitory, that's now meeting this 2022 tight labor market danger, which in traditional economic terms and traditional theoretical terms, the Fed believes it's got to tap the brakes, as if higher wages are a bad thing here, right? I mean, they think they have to cool the economy off before wage pressures really become endemic, and that leads to inflation, when that's not really how this works at all. And they're also worried about something called inflation expectations, where they really believe, because they don't do money, they can't look at the monetary system and say, oh, there's too much money, that's inflationary. They don't do that. So they worry that consumers, maybe they get acclimatized to, or they get normalized to these high CPI rates, and they start to expect inflation, and therefore they change their behavior in a way that becomes inflationary. So the Fed is raising rates based on these two other premises that the market right now is saying, what are you guys thinking? Because we don't see that at all. We don't see the money for this at all.
Jeff, do you think the Fed is more worried about the negative money effects or the negative wealth effects of a crash versus the positive wealth effect of that inflationary behavior changing?
I don't think that that's a tough question, Tom. It really is, because you kind of have to put yourself in the shoes of the Federal Reserve and think, what is it they're prioritizing here? Which, I mean, there's a lot of public speeches, there's a lot of academic research, there's a lot of material available. So you can kind of do that. You can kind of put yourself in their shoes and think, well, if I was them, what would I be doing? And I think there's always that kind of balancing act, because they believe if we go too far, the myth is we're taking the punch bowl away, and that could lead to all sorts of negative consequences. But I think at this juncture, what they're saying, what officials are saying, Jay Powell in particular, but as well, some of the other FOMC members, is we need to take the punch bowl away. That the risks are tilted toward inflation for reasons that we just went through. I don't think they're valid reasons, but they certainly think so. So I think they're going to start raising rates, but I don't think they're going to be overly aggressive with it, because they don't want to go too far too fast. Still wondering if they're still the economy maybe isn't as great as they think, at least they're saying it is. And so they're going to plot this careful course where the balances are, in their mind, tilted toward inflation, but not so aggressive that they're going to do 50 basis points in March, and then another 50 thereafter. They're not going to do that because of what you just said. They're going to tread very carefully until something changes that either tells them they're not going fast enough, or as the market is positioning, they're completely wrong about all of this stuff to begin with.
Mm-hmm. Yeah, it seems like the Fed is basically removed and can only, influence the market. And this is kind of, the last time you and I spoke about QE and how it's only really increasing bank reserves, not actually, injecting money into the system like that. It just really kind of removes one layer of actual direct involvement in the economy, right?
Yeah, they are totally removed. And that's really, I think, the central point here is when we're talking about inflation versus inflation and money, mm-hmm. Money isn't the Fed. The Fed is almost detached. I mean, that's, I'm glad you talked about the swap spreads, what happened in 2008, because that's a perfect, very clear example of how bank reserves are not money and what is. Again, go back to October 2008, the worst monetary crisis throughout the world. The level of bank reserves went from almost nothing to almost $1 trillion in the space of a couple months. Mm-hmm. There had never been more than 67 billion in bank reserves. And that was the aftermath of September 11th. And then all of a sudden we've got 10 times that much. Mm-hmm. But it didn't stop the crisis. In fact, the crisis kept on going, as we know, with swap spreads. The dealers continue to exit the markets. They continue to constrain their activities, regardless of the fact there was all of a sudden hundreds and hundreds of billions of bank reserves that had never existed before. Mm-hmm. So bank reserves are not money. The Fed isn't really directly involved in the monetary system. What it had hoped to accomplish was to get the markets, in quotes, not actual dealers, but just the markets, to instill some form of confidence in them, where they would just believe that bank reserves are money and start thinking, oh, I don't just need to sell every asset I own because I'm getting a call from JP Morgan. Mm-hmm. I can believe that there's money because the Fed says so. And of course, that's not going to work during any sort of monetary crisis, because regardless of the level of bank reserves, JP Morgan's on the phone and they want collateral that you don't have. Right. So it's this mistaken impression that the Fed is a monetary agency, a central bank, when they're really trying to just influence behavior in that can work in a system that's relatively healthy and functioning, and you can maybe change some sentiment around the edges to influence, the trajectory of the economy and financial markets. But when the thing is malfunctioning and you don't have money and it desperately needs elasticity in the monetary system, bank reserves just don't help. But they do influence behavior. Let's be honest. I mean, I think that's what we talked about last time, especially the stock market. The stock market loves bank reserves. Stock market loves quantitative easing and those kinds of things, because psychology is what stock prices are really about.
So in a way, Jeff, can we kind of explain it as when bank reserves expand, that drives other market participants up the risk curve to buy riskier assets to try and capture a return. And in that way, that has made for example, the stock market, that has driven the inflation of the stock market?
No, see, it's not directly there either. And that's the theoretical channel for quantitative easing as well. There's three theoretical channels for quantitative easing. One is the interest rate channel, which doesn't work there. The market lowers interest rates, not the Fed. And I've talked about this with my podcast co-host, Emil Kalinowski, numerous times. Mm-hmm. Even the Fed's own research and studies show quantitative easing has very little effect on interest rates because the market does interest rates. So that doesn't work. The other channel is portfolio effects, which is what you were just talking about. If I'm a bank and I hold treasuries and then I sell them to the Fed because the Fed is doing quantitative easing, which means they have to buy some kind of asset. So they buy the safe and liquid asset from me. The expectation is that as a bank, I no longer have treasuries. I need to replace them with some kind of earning asset. So I'm going to have to go into the marketplace with something riskier. Mm-hmm. I'm going to have to buy a riskier bond, or in the best case, I'm going to lend money to the real economy, which is what the quantitative easing is trying to do, is trying to get banks to lend real money to real economy. But what we find time and time again in every quantitative easing program in every jurisdiction for the 20 plus year history that quantitative easing has been tried, going back to the first one in Japan, time and time again, this portfolio effect never happens. What does happen is the banks sell their treasuries or JGBs or German bunds to the central bank, and they just buy more of the same thing. They don't go out and do more risky activity. They certainly don't lend, because lending has suffered tremendously since August of 2007. I mean, wonder why that happened. So quantitative easing doesn't work through that channel either. And so that only leaves the sentiment channel, which is what we just talked about. Doesn't have much of an effect in the real economy, doesn't have a much effect in the dealer system, in the monetary system, because swap spreads certainly haven't responded. But it does seem to have a lot of an effect in places like real estate as well as stocks.
Mm-hmm. When we think about let's say the behavior of interest rates, in a way, that's the price of money, right, Jeff? We would think that if interest rates were that low, that there wouldn't be a demand for money. Or is it more so that the banks don't want to lend?
Well, when we talk about specifically bond yields, we're talking about the implications of the monetary system, right? Because especially in longer term, 7-year, 10-year treasuries, it's not so much the price of money as it is the consequence of money, right? Mm-hmm. Because as Irving Fisher showed over a century ago, bond yields are growth and inflation expectation. So if the monetary system is reasonably healthy up front, then we would expect relatively healthy, and that health being reflected in longer term bond yields, which would be some level of normal. Mm-hmm. Now, normal can mean a number of things in a number of different places under a number of different conditions, but it wouldn't be what we're seeing today, where we have the 10-year at 2% and basically stubbornly clinging to that level. We can't even get to 3% like we did a couple of years ago, when 3% was ugly and awful to begin with. So we keep ratcheting lower and lower, which tells us that there's something wrong in the monetary system that is restraining growth and inflation potential. So long-run bond yields are saying something is wrong in the system, that over the long run, on average, the market does not expect a lot of growth or a lot of inflation, nominal changes either. In the bond market is very adamant about this, and it has been historically validated time and time again, not just in the last 14 years, but historically speaking, we have this interest rate fallacy has held, where low bond yields, low growth and inflation expectation, a heightened demand for safe and liquid instruments over a long period of time. Those are not the types of circumstances you would associate with loose money, or even just a necessary a level of monetary resources. It's something is restraining that the bond market is telling us that the implications are not good as far as long-run growth and inflation.
Mm-hmm. So, Jeff, what other time period is our current market environment like? Is it too different from any other time in history to try to learn about how this could play out by having, some historical parallels?
Unfortunately, there's a couple of really decent parallels, none of which are very good. That's the problem. I think people have this very emotional reaction when you say this period looks a lot like these other two. Their immediate reaction is, no, this can't be true. You're just making that up. You're just a doom and gloomer. You're just selling crap, and I'm not going to believe you, even though the parallels are almost perfectly exact. And those two parallels, unfortunately, are the 1930s in the United States, as well as the 1990s and 2000s in Japan. We're following along those trajectories very closely. And when I say the 1930s, I don't mean that level of destruction, that level of outright deflation. But certainly markets are pricing long-term prospects in terms of bond yields, as well as other financial indications too. They're very similar to what the bond market was saying in the 1930s, that despite the New Deal, despite massive amounts of gold inflows, for example, monetary expansion, the level of bank reserves skyrocketed during the 1930s. And yet bond yields went lower and lower and lower, saying, this is not going to fix the problem. 1929 represented a structural change in the monetary system, therefore economic growth and inflation potential, which was validated because the 1930s, there was never a recovery. There was never inflation. And because there wasn't either of those things, we ended up with the 1940s, which only added physical destruction and devastation on top of that monetary and financial devastation, which is why bond yields continue to stay low until the monetary system completely evolved in the middle 1950s. So there's a lot of similarities and parallels to what's going on, especially the market view of inflation and growth potential today versus then, as well as the Japanese case too, where you saw bond yields reflecting lower and lower and lower growth and inflation expectations, regardless of what the Japanese government did. The Japanese federal government, I think people may not be aware or they've forgotten, they've done a massive fiscal expansion that puts current fiscal expansion to shame. They created a second budget based on trying to get money into the real economy, and it didn't work. The Bank of Japan pioneered first zero interest rates and then quantitative easing. Bank reserves skyrocketed. And again, bond yields didn't change their verdict because it didn't change the situation. So if there are parallels that we can look back to and say, we're kind of following too closely these others, it's the US in the 30s as well as Japan in the 90s. And that's why interest rates are staying as low as they are. Even though today the Federal Reserve is tapering QE, they're not going to be buying treasuries. Treasury market hasn't blown up. If anything, it's behaving as if there's too much of a bid for safe and liquid instruments, because demand for safety and liquidity tells us a lot about safety and liquidity.
So in that exact vein, Jeff, when we think about safety and liquidity, what is the current time and let's say the current bond yields mean for gold going forward, let's say over the next 5 to medium term time frame?
Well, gold and real interest rates have a very close correlation, or at least they did up until recently. But if the bond market right now, what's happening in the treasury market is short-term rates are rising, reflecting the fact that the Fed is going to start raising rates, as we just talked about. That's going to happen. I mean, really, there's nothing going to stop the Fed from starting its rate hike regime, and they're likely to continue to go on for quite a while because the Fed's head, Jay Powell's head is always in the sand. They're very slow to respond to changes in either finance or economy. So if they get it in their theories and then their boardroom discussions and then their voting patterns where they believe they have to raise rates, they're going to continue to raise rates. And the market is absolutely pricing in several rate hikes over the intermediate term, let's say. Mm-hmm. So that's the short end of the yield curve, as well as the short end of something like EuroDollar futures. But ironically, not something like the short end of interest rate swap spreads. So there's, the market's kind of pessimistic on all these things. But more important than that, longer run treasuries on the yield curve, they really haven't moved nearly as much, which has meant the yield curve has flattened out dramatically. And up until a couple of weeks ago, it had in some parts of the curve, it hadn't been that flat since 2007. So we're talking about real disagreement here, long end of the curve versus the short end of the curve. The short end of the curve says, yes, rate hikes. The long end of the curve says, why are these guys hiking rates? We don't see any real change in growth and inflation. Mm-hmm. And it's not just the treasury curve, EuroDollar futures too, where the EuroDollar futures curve is actually inverted already. And that inversion exploded significantly recently, which is the market starting to say, the Fed's going to hike rates, but there's a chance they stop long before people are anticipating right now, and maybe even have to turn around. And you have to start, you start asking yourself these questions. Why is the market starting to look at the situation like this, where the Fed's going to be hiking rates, but then we don't agree with why and how that's inevitably going to result? And I think the answer is the market is very skeptical and pessimistic about why the Fed is hiking rates to begin with. The Fed thinks that there's heightened inflation risks when the bond market, across the entire bond market, says, no, there's no heightened inflation risks at all. The money hasn't changed. Therefore, it's not inflation, which means that consumer price increases over the last year or so are of the temporary supply shock variety. So it may be that the Fed is actually hiking rates just as that supply shock starts to fall off. At the same time, the global economy is slowing down, which is a whole different ball game.
So what does that mean for gold? Is that positive or negative for gold?
I would think that's positive for gold, because lower for longer is very gold positive. As you know, Tom, I mean, one of the arguments always against holding gold is it doesn't pay an interest rate. So if nobody else pays much of an interest rate, there really is no opportunity cost for holding gold, which is why, especially since 2018, gold prices have behaved almost exactly inversely correlated with interest rates. Right. As interest rates went down in 2019, gold went through the roof, as you would expect, because we not only have lower interest rates that are perceived to be around for a long time, you also have the deflationary, lack of growth, high danger consequences that go along with that. Mm-hmm. And I think gold prices this year, even though real rates have risen based on those rate hike projections, the market is saying that the Fed's going to be hiking rates, you would think that would be very negative for gold. But yet gold has not only hung in there, it's actually done pretty well over the last couple of days, which may be geopolitics, that may be fears about Russia, Ukraine, that kind of thing. But still, gold prices have held up despite higher real interest rates, which I think is instead, it correlates with what's going on in the shape of the yield curve, the flattening yield curve, where the gold market is a reflection of long run treasuries saying, we don't see inflation and growth changing much. We think the Fed's making a mistake. It's not inflationary, but there's still, this heightened economic and hiking economic and disinflationary or deflationary risks. So if that plays out in the short run and then the longer run, I would think that would be gold positive too, wouldn't you? I mean, it would mean that nothing has really changed insofar as, where we were in 2018 and 2019, which was global economy falling off, all sorts of economic and financial dangers that go along with it. Then we went into 2020, where in terms of economy, it actually got worse. And we're kind of fooling ourselves into believing we've recovered from that. So really, if we take away the consumer price acceleration due to the supply shock behavior last year, and then we look at the long run treasury curve, the Eurodollar futures, swap spreads, all these financial indications, I got to think in the long run that those are probably gold positive. They're danger positive, right? We need some sort of hedge against pretty big consequential financial errors. I'm not saying, we're going to repeat 2008 or something like that, but it's much more of a messy situation than not.
So Jeff, on let's say the other side of that, do you think that the safety that has been promoted as part of Bitcoin, do you think that market behavior is showing the exact opposite? That safe haven of having a different type of, quote unquote currency that is outside of the system?
I think it's different in terms of monetary function. I think what we're talking about is, money is a medium of exchange and unit of account, which is where the Eurodollar really is falling apart. There's lack of elasticity, lack of liquidity, therefore demand for safe and liquid instruments. I think what has driven Bitcoin, especially in a lot of cryptocurrency prices over the last year or so, is more focused on the store of value. And I think that's a mistake because, as I said before, people have this impression that the US dollar is going to zero, that the treasury market's going to blow up, that the Fed has printed too much money, and they're buying store of values that they think are going to help them weather that storm. When the US dollar crashes, you better own Bitcoin, right? I think that's what a lot of people are doing. And as we saw in 2018, especially, as soon as the US dollar doesn't look like it's going to crash, people went out of Bitcoin rather rapidly. And there was other things that went on, but I think by and large, the retail investor, the bubbly type behavior in digital currencies and digital assets has been related to this misimpression of the Fed going nuts and printed too much money, the federal government doing helicopter money, and therefore the dollar's going to zero. And we need these store of value type of shelters. And I don't think that's what's there. And I think that's why crypto prices have come down, because there's a realization that, maybe this is not a store of value type of situation. Maybe we should listen to the yield curve. Maybe we should listen to Eurodollar futures and think that maybe there are other risks ahead that are not inflation and not the dollar crashing, which the gold market is almost, it's all entangled with what's going on in the yield curve, whereas cryptocurrencies and digital currencies aren't mature enough to be a part of that systemic whole. So there's a gold relationship that isn't strictly store of value here, that's responding to signals in the yield curve, or responding to what's going on in the real monetary system, that is, even though it's not inflationary, it's still error prone.
Jeff, as you're mentioning, the helicopter money component that we saw last year, how do we think about how that mechanism is able to create inflation and drive consumer behavior versus quantitative easing? Well,
again, I wouldn't call it inflation. I hate to be a stickler. I hate to be all too pedantic about it, but it created a bubble in consumer prices, but it wasn't inflation because it wasn't actually a monetary component to it, and therefore it's not likely to be sustained. What happened was simple economics. I mean, simple small e economics, which was we had an inelastic supply situation because of the COVID pandemic and government overreactions to it. which closed off a lot of flexibility on the supply side. So you have an inelastic supply curve, and then the government comes in and says, here's a bunch of cash for people just because you're people. Here's a bunch of cash for businesses just because we're corrupt and we like to do that kind of thing. They're loans that turn into grants. And so you had essentially a rightward shift in demand. And when you have a rightward shift in demand with an inelastic supply, what happens to price? It explodes higher.
Right.
So consumer prices exploded higher. That wasn't inflation. It was the simple classic supply shock case that we've seen time and time again before the EuroDollar showed up. So yeah, the government was able to temporarily shift the demand curve to the right by doing what it did. But that, again, that was a temporary shift. And ever since then, demand has been slowly normalizing back to the left. At the same time, the supply side has been slowly normalizing more elastic. And as those two things happen, the level of consumer price acceleration starts to decelerate, and eventually it'll start to reverse. And I think we've already seen that in a lot of places around the world. I watch China very closely. And you look at Chinese producer prices, for example, and that's just one example. The Chinese producer prices have been dropping since October. And in December, they were down sharply. So in a lot of areas, I think we're starting to see the downside, the demand curve shifting back to the left, the supply curve starting to become more elastic. And I think that's part of what's driving swap spreads, Eurodollar futures, and the flat treasury curve, which are picking up those signals and saying, we're on the downside of the supply shock. At the same time, the global economy looks like it's slowing down and never really recovered to begin with. There's a whole lot of economic macro danger there, which again, I think is gold positive, which is why gold prices have held up despite higher real yields.
But if the Fed really wanted to have a direct effect in the economy, wouldn't helicopter money be the way to do it, Jeff?
Sure, but the Fed can't do it. I know people say, oh, the Fed can do whatever it wants. If it wants to print money, it'll print money.
Yeah.
And if that was the case, why haven't they done it? You know, it's been 14 years, almost 15. We're coming up on 15 years since August of 2007, and we're still doing the same stuff. And, you know, 13.3 is it gives them broad powers to cite emergency situations to basically do whatever they want. But simply just crediting everybody's account, they can't do that. They have to go through the banking system. Could they go through the Treasury system? Well, the Treasury Department had to go through the banking system too. So there are limitations to what the Federal Reserve can do, which I understand most people don't believe that's the case because they've been taught this myth of the omniscient, all-powerful Fed, that if it wants to do something, it can do something. And if that was the case, we never would have had a 2008 crisis to begin with. So something's obviously different there. But yeah, I get why people are afraid of, okay, we had 14 years of the Fed doing this, but now the gloves are off. Now we're going to do the real stuff. We're going to start cranking up the money, the real money printer, whatever it is. They're going to start using it. They're going to marry the Fed with MMT, for example. And that helicopter money from the federal government last year, that's going to become permanent. And there's the structural change in inflation. My answer to that is, if that was the case, why are bond yields why are they where they are? Why are they telling us? Because the bond market is a hell of a lot smarter than me, especially when you're talking about this huge, sophisticated, vast marketplace. It has information that we could only dream of having. It sorts out all of that, discounts all of these possibilities, including the possibilities we're talking about now. The bond market knows the Fed might want to do whatever it can do. The bond market knows that there are parts of the federal government that are pushing for MMT type programs. And yet it still says yields are low. Inflation and growth potential is low. And they have to be low for a reason. And that reason, in terms of what we just said, has to be that maybe the Fed can't get whatever it wants. Maybe the federal government can't do helicopter money in MMT. There are limits to those types of theories. Maybe this banking system, this monetary system, the drag of it is just too big to overcome. That's really where I'm at. And that's really where Japan has been. No matter what the governments have done over there, the central bank as well as federal authorities, they've never been able to overcome that banking system monetary drag. Right. And maybe that's really what we should be focused on rather than worrying about these other things that are very low likelihood to ever happen, let alone be effective.
Jeff, you brought up the geopolitical situation. And of course, we're talking on Tuesday, the 22nd here. So there's been a chart floating around Twitter for the last couple of days of Russia's holdings of US dollars and their gold reserves. So it ends up looking like an X, where their dollar reserves are basically going to zero while their gold reserves are growing. So what can we imply by thinking about this chart alone?
Well, I don't think the chart by itself is incomplete. It doesn't give you the whole story. And I think you have to think about it. I mean, I understand why the chart's been produced, because it's meant to convey a specific message,
Absolutely,
which is that the Russians are going to use gold as some form of payments, payment working around the US dollar system, which I don't think is a realistic option. And I don't think that's really what's going on here anyway. We were talking about this off air, that the Russians, they were hit with the sanctions after they invaded Crimea back in February of 2014, which was mounted to the U.S. government saying, oh, you can't use SWIFT anymore. Your banks they're cut off from SWIFT, which isn't as big a deal as it may sound, because SWIFT is nothing more than a messaging system. It's not a dollar settlement system. It's simply a messaging system that originates transactions that have to be settled somewhere else. And usually that's CHIPS, which is the interbank settlement system. Russians aren't kicked out of CHIPS, nor are they kicked out of the global dollar marketplace, because the global dollar marketplace is an offshore marketplace. It's a foreign marketplace to begin with. It doesn't have much to do, or a lot to do, with U.S. banks, and it certainly doesn't obey U.S. authorities. So the Russians were never kicked out of the dollar system. They've had an inability to acquire dollars and dollar reserves because their economy is atrocious. It's been horrible ever since 2011 and really 2008. You remember, Russia was part of the BRICS back in 2000 when I forget the Goldman Sachs guy's name who came up with the BRICS acronym. It was Brazil, Russia, India, China, and then South Africa, these roaring emerging market economies. Russia was included in the BRICS because its economy, after the devastating experience in the 1990s, was actually performing very well. It was actually growing rapidly. It looked like an emerging market economy that was going to turn Russia into a prosperous state like China was. Except in 2008 and then really in 2011, the Russian economy never came back from the first dollar shortage, nor the second one. And ever since then, the Russian economy has been sideways to lower, which we live in a non-linear world. So if it's not growing, it's contracting. And for it to outright contract over a long period of time means the Russians are in deep, deep economic trouble. And because they're in deep, deep economic trouble, regardless of sanctions, the dollar system doesn't want to invest in Russia. Not only does it have those economic risks, it also has the political risk, because let's face it, the Russian system is an authoritarian, top-down, arbitrary type of situation. So it doesn't make for a good investment. So the reason that Russians have trouble acquiring dollars, sanctions are part of it, but the real part of it is that the Russian economy stopped behaving like a prosperous economy a very, very long time ago, and it hasn't changed since then. So the dollar market looks at Russia as a very poor investment, and there's not going to be a lot of dollars flowing in there, as well as the fact that the Russians don't really trade anything in terms of merchandise surplus outside of energy. So the Russians have been hurting in a lot of different monetary ways. So the fact that they don't have dollars reflects those dangers. And the fact that they're able to get gold, I think, is just them trying to portray some element of, hey, things are okay. We'll be okay. We'll projecting some form of normalcy or some way to tell the rest of the world that, hey, maybe it's not so bad. You can invest and rely on Russia. When I think most people know that's not the case.
So when we consider those, what you just said there, Jeff, do the sanctions and diplomatic options that the U.S. has trying to influence Russia to temper its behavior somewhat, do those lessen the effect, considering how bad things are with the Russian economy?
Oh yeah, and I think the two things go hand in hand. By what I mean by that is the Russian aggression is a reflection and a direct response to the fact the economy at home is so bad and atrocious. So, I mean, historically speaking, that's what happens. We have authoritarian, top-heavy regimes in a real bad economic situation. They always lash out at their neighbors, or they lash out internally, trying to create a common enemy that isn't the top-heavy authoritarian regime. And so it's classic historical behavior in that respect. So sanctions, they're not going to have much of an effect because Vladimir Putin's problems are much closer to home than they are the global marketplace. The Russians can't compete on the global marketplace to begin with. They don't really have much to offer, and they don't have any much to offer by way of investment opportunities either. So What more can we rob from them? They've already suffered the consequences of this economic situation for a very long time. It's really at this point either fixing the problem, really fixing the problem, or doing something different to deter the Russians from aggressive activities.
Mm-hmm. So Jeff, kind of in your world right now, what are you really watching that is a strong indicator to you of what is coming? Is it the swap spreads? Where are you really looking to see as a warning of the next crash or whatever we're going to kind of see coming here?
Yeah, I don't think, just to be clear, I'm not saying that we're looking at potential for another crash here. That's not necessarily the downside we're looking at. But I would say if it was just one thing or another, that would be compelling on its own. If it was just, for example, the EuroDollar futures curve, which inverted on December 1st by just a tiny little bit, if it was only that, that would be enough to get your attention to say something serious has happened so that this very fundamental curve has distorted its shape into this ugly, flat, and now just slightly inverted shape. That's already a sign that something serious is happening. Mm-hmm. If it was just that, I would point to that and say, hey, this is a big thing. But as we said, it's everything. On the same day, on December 1st, swap spreads began to compress again. So we have swap spreads compressing when they really should be decompressing. The swap spreads should be expanding tremendously, especially if the Fed is going to hike rates. Higher interest rate, higher short-term rates are fundamental input to interest rate swap prices. But yet they're compressing again, and they compress again at the same time the Eurodollar futures curve starts to invert. That's a very compelling signal. And then we have the yield curve. The yield curve flattened tremendously ever since the same time frame, especially this year. So short-term rates have gone way up, where long-term rates have risen a little bit, but not nearly as much. And so, as I said before, the long end of the yield curve in some places a couple of weeks ago, it's steepened out a little bit, but it had gotten as flat as it had been in 2007. So we have all of these things together that are telling us this massive monetary system that nobody pays attention to, the massive monetary system we don't monitor. It is telling you something is wrong here, something substantial is moving in the wrong direction. Again, that doesn't mean we're going to repeat 2008 or there's a crash or something, some massive disasters around the corner. What it means is that the balance of probabilities are stacking up to the downside. And the downside could be a number of different things. It could be that growth falls off again. It could be a mild recession. It could be, a problem in one part of the global economy, let's say China, and the other parts are relatively okay, but they don't experience recovery. And it could be something even more downside than that. But by and large, the market is uniformly, ubiquitously, all over it. It is turning toward these downside probabilities, which also means not inflation as well as not economic growth. So it's not just one thing or another. It's all of these things at the same time that creates this compelling, if contradictory and contrarian indications to what everybody's being told right now, which is, the Fed, rate hikes, inflation. The market is uniform in saying, no. The risks are something else entirely.
Excellent, Jeff. That's I think a good way to kind of summarize our conversation here today. Is there anything else you'd like to touch on before we wrap up?
Yeah, I think we get a lot of it. It's just, I think a part of the problem that I have people, accepting what I'm talking about, especially this hidden monetary system, is why haven't I heard about this before? What is this Eurodollar? Why haven't I heard about it before? And what I tell people is, look, you really don't have to take my word for it. If you actually read some of the history behind it, as well as some of the private conversations of officials like Alan Greenspan or even Ben Bernanke, what they'll admit in private, they won't admit in public, is that the central bank, the Federal Reserve, doesn't do money. We don't know how. The Fed doesn't know how to do money. That's why they discontinued M3, 15 years ago, because they couldn't keep track of the monetary system as it actually is. And when you accept that fact and realize the implications of it, a lot of the last 15 years a lot of the last 30 years, a lot of the last 50 years starts to make a whole lot more sense. Mm-hmm. And so what I say is, don't take my word for it. Listen to the marketplace. The marketplace is the monetary system. The Fed is not the monetary system. Bond yields, swap spreads, whatever it is. Mm-hmm. Listen to what the monetary system is telling you, and then you'll be a lot more informed than if you just, hey, the Fed's doing what the Fed's doing. We just accept their premises for it.
Mhm. Well, it's interesting that you kind of bring that up about that nobody has ever heard of the EuroDollar system. So why does it matter? And you have that quote on your Twitter from Paul Einzig, basically saying, I was compelled not to write about this, right? To kind of bring this system.
We want to keep it a secret. Yeah.
Yeah. So no wonder it's hard to really understand it, right?
Yeah, it started out that way, Tom, but then it continued that way. And the reason was because in the 1960s, it was solving Triffin's paradox in a way that the officials in the United Treasury, at the Treasury or the Fed, they couldn't. Mm-hmm. So they were willing to look the other way because it was doing them a favor. Yeah. And they thought, as long as the Eurodollar system is doing us a favor, we'll just ignore it. And then, of course, that led to the mistakes of the 70s and 80s, where we now have a monetary system that was out of control. The Fed kind of said, we don't do money anymore. We can't. Mm-hmm. And so it was one thing after another, where the Eurodollar system was essentially buried under politics, as well as, a whole bunch of mythology about the Fed that, here we are in 2022 and nobody's ever heard about it. But yet you go back in time, especially in the 60s and 70s, there's tons of scholarship. There's tons of discussion about it internally that just, eventually it just got lost to time. Mm-hmm. But it didn't get lost to time in terms of its actual function. It's been there the whole time. It's the reason why the economy behaves the way it does, the way financial markets behave the way they do. So it's there, even if we don't know it's there, we don't recognize it.
Mm-hmm. Excellent. Jeff, of course, all your articles are available at alhambrapartners.com. And your Twitter handle is Jeff Snider _AIP. Of course, we'll have those in the show notes as well. Jeff, thanks so much for your time today.
My pleasure, Tom. Always a pleasure to talk.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.